Well, welcome everybody. Thank you for joining us on the second of the podcasts that we are putting together following the budget of 25. I'm joined by Nicky Larkin of Succession and Goringe, who you may remember from our last podcast. Welcome, Nicky.
Good to be here, Stuart. Thank you for inviting me again.
Thank you. And as promised, we agreed that we would, having made some predictions, for a number of reasons, quite happy to say, didn't come to fruition,
Yay!
in the 25 autumn statement. But there were nevertheless a number of points and items that came out of that budget that I think are very much relevant for the SME owner, or indeed those looking to acquire those types of businesses or dispose of them, and a twist as it were around employee ownership trust that we'll come to later. Nicky, do you want to take us through your observations?
Yes. Well, so there was so much discussion before the budget, and obviously it was actually even leaked just beforehand. So short term, there wasn't any surprises. But yeah, a lot of the things that we talked about last time, very fortunately, and we're very pleased about, haven't come to fruition. So we're really pleased. So there wasn't any change on VAT. There wasn't any change for those having a legal limited liability partnership structure. But the legal structure of that is the LLPs. Sorry, tongue twister there. So there was no change for there, which was good. There were, however, lots and lots of other changes, some of which we will touch upon today. But I have decided to be half glass full, as I often are, and I just think it could have been a lot worse.
I think that's a very fair comment. I think that's a very fair comment. As you say, the NI contribution discussions around LLPs didn't bite, to the relief, I suspect, of many law firms. The VAT thresholds remained unchanged. We pondered last time as to whether or not those were going to be cut, and the cash flow implications that may bring, but they of course remained.
And also additionally with the VAT, it was partly about the potential change of the thresholds, but there had been talk about putting VAT on other things such as financial services and healthcare, and there wasn't anything actually happened with there. So that was a big relief. So not having to completely change a sector there.
Yeah, yes, and our friend capital gains tax.
Yes, no, because that would have been, a lot of the Labour, it seemed to be designed to make the Labour backbenchers happy, and that would have been a win for them, to up the CGT. But fortunately, in most circumstances, there's one that we will touch upon. In most circumstances, there wasn't any change after last week's budget. So we're still talking about business asset disposal relief, currently at 14%, going up to 18%, 6th of April 26. And then it's 24% after your basic rate. So no change there. If you're planning to sell, then there's no change there. So you can keep going with your disposal.
Thank you. And then where we saw the largest change around capital gains tax was around the taxation of employee ownership trust. Now, employee ownership trust, for those unfamiliar with the term, are a fairly new structure that came in off the back of cross-party review in 2014, which used to enable founders to sell their companies, their shares, into a trust vehicle for the benefit of employees, and that was treated as tax neutral, i.e., no charge to capital gains tax or any other tax on that disposal, and therefore conversations around business asset disposal relief were not relevant. That is no longer the case, Nicky. Is that right?
No, indeed. Yeah, so this was a big surprise, and this was also effective immediately. So if you've been in the middle of planning for an EOT, you will be affected if you hadn't already completed it, because now if you are the founder selling your shares to a trust, you are going to no longer have 100% exemption from capital gains. You're now only going to get 50% relief. And you're not going to be allowed business asset disposal relief. So you're basically, the bulk of that's going to be at 50% of 24%, i.e., 12%. So I've talked to several people that I know were planning to do EOTs. In their instances, they aren't going to change their mind. They're still going to do an EOT, but it has changed their timing and how they're going to do them a bit differently because, obviously this is a tax position that they weren't expecting. It really does mean as well that the EOTs are most likely going to only now be for cash-rich businesses. It's very unlikely other businesses. So I am completely shocked this one. I don't know about you, Stuart, but I am really shocked about this one because I would have thought that would be a good thing encouraging employee ownership by Labour. So I'm very surprised because I think the consequence of this will be that there will be fewer new EOTs set up.
I think from those that I've been involved with, the key drivers have been around legacy, continuity of culture, um, rather than looking for the tax advantage that comes with that versus a trade sale or other disposal. However,
But perhaps I've just been talking to slightly different motivated people.
well, I do, I
Focused
do,
on
I
one
do think
tax advantage. Mm.
I do think that a number of those that there are a number of businesses or founders out there that were probably drawn to the tax benefits versus the legacy um, element that's involved. I've always said that they're not a structure that suits all businesses for a number of reasons, not least the fact that you're limited to what value you might otherwise extract, i.e., if you were able to get a larger multiple from a trade competitor, that would be a preclusion from disposal because under the EOT rules, you can only sell for um, deemed fair value. So I'm not surprised, and I suppose when you think about it, when you do the maths and you get to, as you say, 50% of generally 24%, 12%. For a lot of businesses, you're not a million miles away from the tax regime that would bite if you did get the benefit of BADR um, on the first million, or the BADR in business asset disposal relief, the precursor to entrepreneurs relief, and the balance on conventional capital gains tax rate. I suspect when you do the exercise,
I mean,
it's probably not a huge. There's probably not a lot of difference in the tax between
yeah,
them.
I mean, I think what you're looking at is because it's at fair value. The thing is, in reality, if you're doing a third party sale, the offers that you will get will range significantly. Typically, when I'm dealing with third party sales in succession planning, the offers we get, often the top offer is twice the bottom offer. And pretty much they're usually more than what you would have calculated if you were doing a fair market valuation for an HMRC clearance. So unless you're in your clearance and evaluation to HMRC, you're really pushing the boundaries. Yes, the tax would be more on the third party sale, but what you'd hope is that you would be getting more of an offer. Of course, the cynical amongst everyone will be thinking, well, at least will hopefully get the money out fully if I've got an EOT, and they worry about, are they going to get their deferred money out from another sale? But it's swings and roundabouts. Some things you have to look at each circumstance differently. It's going to be different on each sector. It's going to be different depending on the size of size of the business. So as always with these things, you need to talk about, get advice on your particular circumstance.
And that must be right. You must always plan, and take the advice of appropriate qualified specialists in the field, such as Nicky. Um,
And not ChatGPT, just to be clear.
um, what interestingly, we did touch on it, and quite positively, the Chancellor didn't feel the need to play around with the tweaks to BADR allowances that she introduced in the 24 autumn statement, and quite positively for the small to medium sized business. She did introduce some increases in the qualifying thresholds for EMI, employee management incentive share schemes, which I've seen certainly over the last couple of years a huge uptake in for businesses as a way to incentivize key staff, tie them into the business. Doesn't involve huge cash advances in the way that bonuses would be, but does involve and does enable those key people to share on an exit event if they stick with and grow the company. Essentially, I mean, Nicky, do you want to just outline the ENI scheme in simple terms, and then
Of
perhaps tell us how those changes to thresholds have come about, and the detail around them?
Indeed. So for those not familiar with them, EMI, this is the Enterprise Management Incentive Scheme. So essentially, it's usually where a business is offering EMI options, so share options to their team. So it makes sense that this should usually be a growth business because that it's got to have the incentive, but it's a very, very tax efficient structure to do. It's not even too expensive to implement either. You still do need to have a good lawyer and accountant set it up for you, but it's not a very expensive scheme to put in place. And it's got a fairly structured way to do it. But it gives a lot of good tax benefits doing it for the company and for the individuals that get invited. And the change is from the 6th of April 26, so just a few months away. And the key changes are, as Stuart said, it's widening it up because it's going to be open for businesses that are a bit bigger than currently. So basically the criteria at the moment, you can only do it if your gross assets are up to 30 million. You can't do it if it's larger than that. But from April, you're going to be able to still participate in this scheme if your gross assets are up to 120 million. And from an employee perspective, you can go, instead of just up to 250 employees, it's going to be up to 500 employees. Also, the amount of shares, value of these options the company can grant under the EMI scheme is going to increase. Unfortunately, it's not going to go fourfold like the amount of gross assets, but it is doubling. So it's going up from 3 million to 6 million. So it's quite a significant amount of shares that can be given under this. And obviously, if you're a growing company, that 6 million hopefully will grow quite quickly to more significant figures. But another key, this is a good one for red tape reduction, is the exercise window currently is at 10 years. That's going to extend to 15 years. So you've got longer to have these in place before you have to start messing about with updating things and doing new grants, etc. So that's very welcome news for actually reducing red tape, that one.
Thank you, Nikki, and I think it's always good to end these things on a high, really. There you go, the 2025 autumn budget. The general consensus is it could have been worse. Um, as ever, thank you all for listening, and I hope you found this useful. Of course, there's plenty in the budget. We primarily focus on it from what we think's of interest for owner managed business owners, those looking to buy them, and those perhaps looking to sell. Thank you, Nikki, once again for all your insight and commentary. Until the next one, I'm sure there will be more as we continue our podcast series on our snippets and ideas and views on how and what we feel those business owners or those looking to acquire those sorts of businesses should be thinking as we move into the new year. But in the interim, I hope you and your respective families have a wonderful, wonderful festive period and a very successful and healthy new year. Bye for now.
Bye. Thank you.